Wow, guys, what a December we are having. Joe Baker, trade pilot. Just going to go over some analytics here with the Western bar chart. Had a few requests for um, understanding inside and outside days. So we're going to go over just the general principles of a standard bar chart in price action because all the indicators we use every day in our trading, either daily, intraday, 5 minute, 10 minute, they're all derivatives of price anyway. So you get your high, your low, your open, your close. You can see the ranges there where you got the open and the close. That's the body, that's the fight. That's where the battle is. That's basically where you would consider your point of control is be in between there. So obviously it could be a wide range based on the time frame, whether you're using dailies or, monthlies, weeklies, intradays, 5 minute, what have you. Always look at it this way, just to get your head into it the right way. Look at it as price rejection based on your open and close. It's a good way of understanding what the noise factor in the market is, so that you don't kind of get thrown around a little bit by these dips down where they come in and take out your stops and then reverse and take off again because you go, oh geez, I've got to get out, I'm going to, and then it reverses, that type of thing, which we all have experienced. But it's better when you understand the range, the true range, which is the open and the close of either the if you're using candlesticks right now, we're just going over Western bar charts, but understand that's where it is. So price rejection is what the tail is, or quote, market noise. Now obviously we can have a lot of that any given day where price rejection can be huge. You typically see it at market highs and lows, long tails. Here's an obvious, very simple method. It's obviously higher high, higher low. And a period of higher highs and higher lows is an uptrend. A period of lower highs and lower lows is a downtrend. I understand this is fairly simple to understand, but when you're in the trade and your emotions are flying and you're heated or in the wrong side of it, you sometimes can't get a grip on what the market's doing, or maybe you just don't feel like you're in sync with it. So just pause. Maybe if you're in a trade, just just get out of everything, take a minute, take a breather, and just take 5 minutes and say, okay, draw some trend lines. Say, are we making higher highs? Are we making higher lows? Are we reversing? Are we rolling over? I mean, you got to ask yourself these questions throughout the day, because we kind of will sometimes the market to do what we want it to do, based on what we're hearing. And I understand, guys, news is planted. Okay, the traders actually plant the news. So they get Bob Pisani, they get whatever, and they plant some news about the housing sector being this and that. Next thing you know, as soon as Pisani comes out and says it, the market reverses. Everybody gets short and they get run over. So understand that. Just get an idea of what these markets are doing, what the trends are doing, and it can get you on the right side, at least on the right side. So even if you have a poor entry, you didn't get the best entry, but as long as you catch the trend, you're going to get bailed out of that trade anyway, because the trend's either up or down. This is something I'm going to give you guys a little trick on. I don't know where I learned this, but you guys get a kick out of it. When you're making a reversal, basically the start of a new trend or an uptrend from a downtrend or a downtrend from an uptrend, look at it like look at your hand, okay, and look at your fingers, your index finger, your middle finger, your ring finger, and your pinky finger, and kind of, you can put your pinky finger down, but you can look at the three fingers, your index finger, the middle finger, and the ring finger. On an uptrend, when the markets are reversing, the market kind of, if you just put your fingers down and look and do this on a bar chart on a 5 minute or a 15, it is kind of cool. The market's kind of giving you the bird. Okay, and that means the trend's over and it's going to reverse, and it looks kind of like the three fingers up. And the same on the downside. If you see the pattern where you have a lower low and then two higher lows side by side, that means the downtrend is typically over. Same to the upside. If you see a lower high and a lower high encompassing a higher high, that typically means the market's giving you the bird, and it's going to reverse on you. That's a cute little trick to remember. Tends to work more often than not. Go back and then check your charts, guys. You're gonna be surprised at how often that is than not. Expanding and contracting ranges. Very, very important to understand how markets move. Markets actually always move from expansion to contraction, contraction to expansion. Everyone thinks they do a peak valley thing. They do that, but understand that markets, even in the peak valley range, they will be building pressure for the next move. So even if it's going up, down, up, down, up, down, 3.5, 4 points, what have you, it's just building pressure for the next move. So understand that we do have some indicators that we call it the Connex indicator, which is contraction expansion. Kind of lets us know when the market is in contraction phase. And during that contraction phase, very, very important to get an understanding of what way is this thing going to break. If we've gone up, say, 6 points in the S&P and it goes sideways and it only comes down 2, I can tell you right now, guys, that market's going to blast up. Okay. Same thing to the downside. We drop 6 points, we go sideways. We maybe regain 2.5 points, but on a sideways move, that market's going to roll right over like a stair step. Markets can do what I call either peak valley trading, stair step trading, or that slope of hope where it's just that long grind all the way up one day. But the stair steps are the easiest to identify. They just go sideways, and a lot of people call them bull flags or bear flags. They're highly noticeable once you get a chance to see them. So just go back again, everything I say, just go back again, look at your charts, get a feel for it, see what you're seeing. I'm not trying to tell you exactly what to do, but just see what stands out to you. And watch those stair-step patterns. They are dangerous and evil, because I think what it is it comes down, goes sideways a little bit, builds up more pressure for the next move down, for more long liquidation, or for the same reason to go up. Goes sideways and then blasts up. Everybody gets reshort because they think the market's finally going to break, and it doesn't. So food for thought there. Again, here you got to watch your ranges. Sellers in control. When it closes and opens very close to the same, that means it's indecision, or if you guys are candlestick guys, those are dojis. The dojis at the top of a chart or the bottom of a chart. Those show, indecision or price reversals. They can also mean continuation. So, just again, get those spikes up on the back. Know something's coming. Go back and look at your support and resistance areas and your pivots, because something's going to happen. Again, closing at the high end, all that price rejection. So they tried to sell it off, they couldn't. These guys came in, they bought it, they're going to push this market higher. So just kind of watch those bar charts, or candles, if you understand, and you can still see the tails of the candle. Understand the tails are just noise. That's how you can judge how much noise is in a market, basically by the tails. So understand, if you just look at the bodies of the candles, and you can get a much better idea of what this market's truly telling you. Inside days, outside days. Very important. They always talk about this on CNBC every morning. You'll hear some guys saying, "Oh, well, we had an inside day yesterday, outside day, what have you." Inside day, outside day are, okay? If you have a large range, okay, big high, big low, maybe 20, 24 point S&P, what have you. It doesn't even have to be that, but the next day, the whole day's range are encompassed, inside that day. The market is now consolidating, and what it does when it consolidates, guys, is it gets ready for the next move. So that's why these guys are always watching this, and they're saying, if it takes out this level, you're going to see buyers come in this market, or if it takes out this lower level, you're going to see sellers come in this market. That's why you have to understand how these days work, because what you're doing is you're putting everybody in a losing position once it takes out the low, or you're putting everybody in a losing position once it takes out the high. Either way, it's going to break. So these guys are ready for this thing to break. Typically catches us off guard, because we're not looking at daily levels. We're looking at our intraday charts to kind of catch the next move. We don't realize that we just, at some point during the day, we may have taken out the prior day's high, and that's it, man. And this is when these markets sometimes just fire up like crazy, or the same thing to the downside, they just sell off. So understanding what an inside and an outside day is would be the same thing, would be the markets consolidating, and then range expansion. Okay, and then you're looking for the next day to take out that prior day's high or low, and then you know that that's where the market's going. That's its next major trend. Any questions, guys? Just feel free to email me. I hope this helps. Always remember, price is paramount. Okay, so understand that the markets will stay within that range of the opening close. Don't ignore the tails, because obviously if you're in the trade, but just understand that's how much noise you can judge is in the market. It may help you trade a little bit better and may keep you a little bit more comfortable